There's often a lot of confusion as to how you should handle a prepayment. And I think, first of all, we need to understand what a prepayment is, and we're looking from a payables perspective at this point. If a supplier asks you for some money up front and you pay them without receiving an actual tax invoice, then that is what is classified as a prepayment, because you're making a payment before you're actually receiving an invoice to pay, i.e. it's the prepayment of the invoice. And if we were to look at this on the system, we would be able to identify that a prepayment here should be calculated without any tax, because as I've just said, you are making a payment before you've received the tax invoice. Now, if you have received an invoice from your supplier and your supplier has charged you VAT, then it is not a prepayment. That is a standard invoice. It's a standard taxable invoice. And in this example here, you can see that the VAT has been charged. The difference, of course, is that when a standard invoice is entered, you will enter that invoice into the system. You will charge the VAT, as we have seen here, and then you can recover that VAT. With a prepayment, you're not actually receiving any money at this stage. Sorry, you're not actually receiving an invoice at this stage. So there is no VAT to recover. And if you receive an invoice from your supplier that has VAT on it, but it does not clearly say that this is a tax invoice, then you should be rejecting that invoice in the first place. A supplier cannot legally charge you any VAT on any invoice or a request for payment unless they give you a invoice that clearly states tax invoice. Now, if we actually look at this diagram here, this is designed to try and explain the actual process of a prepayment and the correct way of entering that prepayment. We've got this split between three different periods. So we've got January, February and March, and we're splitting this between the invoice and the payment. So the invoice issued by your supplier and the payment by your purchaser, the VAT treatment of the supplier and the purchaser, and then the VAT that would be paid or recovered by that supplier and purchaser with the tax authorities. So let's first of all have a look at this. So if a supplier was to send you a request for payment, what they may do is send you a pro forma invoice. And it would clearly, on that pro forma invoice, it should clearly say this is not a tax invoice. So let's say they send you an invoice for $100. You would then enter that invoice into your system as a prepayment invoice. And so therefore, as there is no tax on the invoice, you cannot recover any of the tax. Okay. Then you would make payment for that invoice, and it would go onto your system as a prepayment. Your supplier would then receive that money. Because they have not created an invoice yet, they would put that invoice as an on-account receipt. So that money is on the system. They know they've received the money, but they know there's no invoice for it. So with that $100, they have to legally adjust now for the VAT. Because VAT is due when you create an invoice, when you deliver the goods or services, or when you receive payment for those goods and services. And you are receiving a payment at this time. Now, you'll notice here that the 5% of the 100 is not 5, it's actually 4.76. And that is because the 100 is actually an inclusive amount. So your supplier will, behind the scenes, they will actually have to make an accounting entry and an adjustment on their tax return for that $4.76. Now, at this point, they have not sent you an invoice, so therefore you cannot recover any of the tax. Now, from a VAT treatment point of view, in January, the supplier will record the $4.76 as the VAT on their on-account receipt, and that will be on their tax return. But there's nothing on your tax return as the purchaser. And then if we look at the VAT authority, they're going to receive the $4.76 in January, and therefore the balance that they've received so far for this transaction is $4.76. Now let's move to the next month. The next month, the goods or the services have been provided, and the full invoice is to be sent. So the invoice in this example is for $1,050, which is for $1,000 plus 5% VAT of $50. Okay, so it's 1,050. They will then send that invoice to you, and you would enter that invoice in the system as $1,000.50. So the line will be for 1,000, and then the tax will be for $50. At that point, because the invoice has been created now by your vendor, they will have to adjust the previous VAT adjustment they made in January, i.e. that $4.76 that they set aside for the $100 received, they would now reverse that out because the VAT for the full invoice has been charged on the actual tax invoice. So the supplier would not want to be charging and be liable for the VAT twice. So when they create that invoice at the same time, internally, they would be adjusting and reversing out their $4.76. And what they would do is, so when they send you that invoice, you would enter it, and you would at that point apply the $100 prepayment. So as far as you're concerned, you've already given them $100, and therefore you can apply that to the actual invoice, and so therefore the balance due is now $950. Okay. Now let's have a look at the VAT treatment. The VAT treatment has now changed because we've now issued the correct tax invoice, which is for the $50. However, we have to reverse out. So there's a VAT credit of the $4.76 on the February return to reverse out the tax that you'd already applied in January, as you can see here. So on the actual VAT return for your supplier, they would actually be submitting in February a VAT amount on their sales of just $45.24, because that is the $50 on the invoice less the $4.76 that was on the credit. Now on your side, the purchaser side, you've only received the one invoice now. So you would enter that invoice for the 1,000, the tax is 50, and you can recover that tax of 50. Now what gets interesting here is that on the VAT authority side, they're only now receiving in the month of February $45.24 from the supplier. However, there's a minus 50 here because this is the amount of tax that you as the purchaser can recover. So there's a difference amount here, i.e. you are recovering more tax than the supplier is actually paying to the authorities. And the reason for that is if we look at the balance down here, if we take the $4.76 that was recorded in January and you add the $45.24 that is recorded in February, then the actual amount of VAT paid to the authorities is $50. And likewise, if we look at the amount that in January that the purchaser recovered, which is 0, and then you add the amount that was recovered in February, which is the 50 or minus 50, and the total balance here is 50. So these amounts actually net off to 0 because the purchaser can recover all of the VAT. And then finally here we've got a payment because we're saying it's 30 days. So the actual payment takes place in March. We pay the balance because we've already paid 100 up front. And so therefore we've got the total balance due is just the 950. i.e. 1,050 minus 100 is 950. Now, in the month of March, there's actually no treatment at all because we've made a payment. So there's no VAT treatment on either the supplier or the purchaser, and against the tax authority, there's no amount either. So that's very, very important that we do it this way. So here's an example where we believe a lot of companies are making a mistake when it comes to prepayments. In this example, same situation, invoice is in this case is a tax invoice. Instead of it being a request for payment, the supplier has actually sent you a tax invoice for 100 plus the 5 VAT. You will enter that as a prepayment invoice in Oracle. So in your system, you'll record it as a prepayment, and you will be able to record the VAT as a separate line, and you'll make that payment to your supplier. Now the VAT treatment is simple. The supplier will record a sale of $5 for the VAT, and you as the purchaser will record the recovery of $5 for the VAT. So everything there is above board, and because your supplier has sent you an invoice for the 5%, you are in your rights to recover that VAT. And the tax authorities will receive the $5 from the supplier, and then they will credit back out to the purchaser the $5 as it is recovered. Now, let's have a look at in February, where the goods or services, as our previous example, have now been supplied. So the goods and services have been supplied, and the supplier is now issuing you the invoice for the full amount, which is for $1,050. Now, we, as a purchaser, would then enter the invoice as $1,050 because that's what we've received. We cannot make adjustments or make anything up. We have to take what is on the invoice that has been sent to us. It's a legal document, so the line is $1,000, the tax is $50. At this point, we can apply the prepayment. So the prepayment that we've received before is for $105, as we can see here. This means the actual balance due is actually only $945. So that's what we would be paying to the supplier in the month of March. But before we do that, let's have a look at the VAT treatment. So we've already recorded $5 in January, as you can see here. Now we're recording another $50. So in January, we've already submitted a return for the $5, and now in February, we're going to submit a return for $50 because this is on the invoice. On the supplier side, we will have the invoice for $50, but the way Oracle works and the prepayment is applied, because there was VAT on the prepayment, we have to deduct that amount. So actually, when we actually process this, the amount that we will report on our return is only going to be $45. So that means the return is what we're recovering is $45. So if we now look at the balances to the VAT authority, January they paid $5 for the supplier, and then they registered another $50, which is now a total of $55. And in for the purchaser point of view, we have first of all in January the balance was $5, and then we've added an extra $45 in February. This gives a total of $50, and this amount here is actually correct. So from a financial point of view, or from entering the invoice and the amount of VAT we can recover, we as the purchaser will be correct in terms of the amount of VAT that we're going to submit and recover back from the authorities. The problem, however, is that the supplier must be doing something to adjust the amounts so that they can reduce the balance from that 55 down to 50. So technically what they should be doing is that in January, as you can see here, we've got the invoice that is for 105. That's all above board, no problem at all. But in February, instead of sending the invoice for 1,050, they should really be sending you the invoice for 945. So that's 900 for the balance due, and then 45 for the tax. And then the total would be 1,050. If, in this example, they do send you the full amount for 1,050, and you apply the prepayment of 105, the supplier has to make an adjustment somewhere. So the only way they can legally do that is if they create a credit note. They have to create a credit note of 105. Now that credit note is actually a legal document, and technically they should be sending you that credit note. So if you are applying prepayments on a purchase from your suppliers for the VAT, then yes, you can enter it with VAT, but your supplier is creating a credit note to adjust their system, which they could send to you, but they're not because of the way you're processing your invoices. So technically, it is possible to enter VAT on a prepayment, but you shouldn't be. You shouldn't be at all. You have two options. Option one, if you receive a tax-only invoice, enter it as a standard invoice. So the amount here that we've got is we've used 1,050. So this would indicate that we've received a request for payment up front of 1,050. We pay that, and you can see here that the tax is 50, and we can recover that. And then when we receive the full invoice later on, then we would hope to receive a balance due, or we would receive a credit for the 1,050 and then the correct invoice later. If you receive an invoice that has no tax on it, then it's not really going to be a tax invoice. It's likely to be a request for payment, such as a pro forma invoice. If you receive one of those and there is no tax information on it, then you can enter it as a prepayment invoice, just as we have here, this is prepayment type. That should have 0% tax on it. So you can see here that the invoice has been entered in 1,000. So what happens is that when that invoice is matched off, it just comes off as a payment. And if you think about it, whether you pay them in advance or you pay them later on, the payment itself doesn't contain any VAT. And you could be in a situation where you make a payment prior to the to a period where maybe the tax is being increased from, say, 5 to 6%. And so therefore, if you were to start calculating tax on prepayments, you're likely to have problems with VAT reconciliation later as well. So this is something that you need to bear in mind. When you're entering an invoice and it's a tax invoice and it's for an advance payment, treat it as that, an advance payment, i.e. this is a payment or an invoice for services in advance of the work being done, but it is an official tax invoice. And if it is a request for payment, where you would either issue a receipt or the supplier would issue a receipt to say, yes, we've received $1,000, or it's an invoice in the form of a pro forma and it clearly is not a tax invoice, then enter that as a prepayment.